So far we've talked about different ways to get in. So some ways you could get in would be support and resistance, whether that's a retest of support, indicators, and market trend. So I want to show you guys, like, we're just going to go over an example of all three ways we can possibly get in the market using these concepts. And I know I spelled this wrong. So first off, support and resistance. So to sum it up, how would we get in using support and resistance? Well, again, if I were to be looking for a line where we bounce off of a few times or reject a few times, so let's say right here. So here we kind of got a level where price to me. So let me just go over my live thoughts. I see us reject. Okay, see us reject again. So what I'm going to do is I'm going to place a sell limit order up here for the next time we hit it. It's going to get me in a short position. So, okay, we kind of hit it again. So I'm going to take a sell here. And my stop loss is going to be above it. And I'm going to buy back here. And we've now made money off of this resistance. So this is how you get in using support and resistance. And again, let me just go over support real quick. Okay, so let's say I see price bounce here a couple times, and again, you can see price bounces here. So next time we come down to it, I'm going to place a limit order here and see if I can get filled. So I'm going to buy there because I think, oh, this is support. And we go up, blah, blah. And that's just one way to enter the market. So I'm going to sell there for profit. So that's how you get in using support and resistance. Okay. So the other two are going to be a little different. Where did I even put them? So not sure what happened to them. Oh, well. The other is indicators. Indicators and then market trend. Okay. And then support and resistance, obviously. And those are the main things I've taught so far. So indicators, let's use like a VWAP is a popular one. Or let's use a EMA. Let's just use this one. So we got the moving average. We'll use the 9 EMA. So I don't like how VWAP looks here. This kind of looks really bad. We'll just use VWAP right there, and we'll make the color orange. Okay. So we got VWAP and we got EMA. So an example of how would he buy using the EMA? Well, an example would be something like this. Let's say we're below the EMA. So here's a 9 EMA. This is an indicator. This basically tells you the average of the past 9 candles because it's the 9 EMA, which I could change the length of that. I could do 20, I could do 30, but because it's 9, it's telling me the average of the last 9 candles. All you do is when we break back above the EMA, such as right here, you want to get back in when we kind of retest it. So see how the candle kind of comes down, retest a little bit. So I'm going to take a buy here because we're kind of retesting it. And then price will this will act as support, right? So this EMA is going to act as a support. It's going to act as a trampoline, and then I can sell for profit up here. So that's how to enter off of an EMA, which is that. So now let's say I want to use VWAP instead. Well, VWAP doesn't really get retested here, okay? So an example of maybe buying off VWAP would be maybe right here. So see how we're kind of below VWAP? Now, when we break it right here, I think, oh, well, we broke it. I'm going to buy. Now, where would it be a good spot to put a stop loss? Well, under support. In this situation, what would be acting as support? This line would, VWAP, volume weighted average price. All right. So I put a stop loss under here or a stop loss order here because I know if VWAP doesn't hold, then I'm going to get stopped out and price goes in the profit. So again, you can combine these. You can enter off of one of them. You can just, all these indicators is support and resistance. And I taught support and resistance like using naked price action, using just price levels. But again, indicators are also used as support and resistance as well, just like how you see price bounce off of something a few times. Okay, so that's how to get in using VWAP. Now, what some people do, or what you can do, is you can use a couple different indicators and use just a bunch of things. So if I turn on, I'm going to take this off real quick. If I turn on MACD, which is moving average convergence, okay. Now look at this. I see, okay, right here, what do you see? You see the MACD is telling us we're going down. Okay, so see how this is going down. Now, you can see this EMA and this VWAP. Where are the candlesticks? Where are the bodies? Where are the wicks? The bodies are all below these two lines, meaning this for right now is going to be resistance. So people are shorting here. So when we get this, or when we get this break, you can see the MACD start to turn green. You can see these moving averages start to cross over each other because they were in a downtrend. You can see they start crossing over. And now you can see we're now above both VWAP and now we're above the EMA. So because we're above both, I now expect this resistance to turn into support along with the MACD curling back green. So I might buy here. And that might be, and that's like 3 different confluences. And then when MACD gets really high, I might sell. And I get out of the position because MACD is really high. And I think it might curl back down. And indeed it does. See how it goes from green to red and it curls back down. So I got out at a good spot where I see, okay, the MACD is up here and we kind of curled down. Or another thing you could do is see how this candle closes back below the moving average right here. You could get in a short there because we closed back below the moving average. You're like, oh, well, if this isn't acting as support, then I think we're going to keep going lower. And indeed we do. And it also kind of lines up with MACD. So that's kind of one way to use indicators, which again, we do not use, but a lot of beginners will check them out and they'll learn why. They'll get wrecked. They'll lose thousands of dollars using them, and you're going to quickly learn. But again, I just want to make sure like you guys know how to use indicators, because what I'm going to teach you, you need to understand what not to do before you understand what to do. So you just need to understand indicators and why they're so bad. And if you ever see someone mention EMA and VWAP or whatever in a Discord chat or whatever, just know they're probably most likely not, most of the time, not a great trader. They probably don't know where the market's going. Because again, this little line right here is not going to tell you the market's going to go. I'm telling you. This line will not tell you where the market's going to go. It might give you like an entry. It might tell you, oh, we're going to go up a little bit, but it's not going to tell you where to sell. It's not going to tell you where to buy. It's not going to be precise. It's not going to tell you any of that stuff. Okay, and you have to understand that, all right? So just know that, yes, it may work sometimes, but look what happens here. See how he closed above this, and then below, and then above, and then back below. And see how it's very complicated where if we close above, so it looks like it's a good buy signal, but then price closes back below, so you might want to get out, but then price closes back above, then back below here, right? So do you see how it's just not good? Okay, you're going to lose money trading this. So that's the second way to get in a position, all right, using indicators. And again, you can use multiple confluences. You can combine 3 or 5 indicators, and if they're all giving you a signal, like a buy signal, you could buy. If they're all giving you a sell signal, you could sell. So that's just how that works. And then the third is just simple market trend. So again, we understand from the market structure video that, again, when we're in an uptrend versus when we're in a downtrend. So if I see, oh, we're breaking structure to the high, I'm going to buy the next retracement right here. That's going to be my entry. So I might get in here because I think, oh, well, we broke structure to the upside. We're continue making higher highs and higher lows. So I'm going to buy the next pullback before we hit the next low, because I know if we're in a true uptrend, we're not going to go hit this low, right? So that's how to get in without indicators. So for example, right here. So we make a high. We break this high. Now, this was the last lower high. So we get a lower high here and a lower high here. Now we break this last lower high, meaning, okay, now we kind of got a market structure shift, or in other words, an MSS. And we now think, oh, well, the market that was downtrending, now it could be reversing here because we broke it. So I'm going to kind of watch. We make a new high here, new higher high. And then we break it again. So what am I going to do? I'm going to buy this next pullback right here, because if we truly broke structure again, then price should typically look something like this. What did I do over here? So I see I'm going to buy in the next down close candle. So I might buy here because I'm like, oh, well, we hit there. I'm going to buy now. Maybe I'll buy again. So now because of market structure, I know we should go up there. And indeed, we end up going up there. So that's how to buy and use market structure, right? We have a lower high. Now we break structure. We make a new higher high here. We pull back. I don't take this entry. We break structure again to the upside, confirming that we're probably bullish. So the next pullback we get, I might buy because I expect us to bounce somewhere in the zone without hitting the last higher low. Because if we're making a last higher low, should we truly break this if the market's bearish? No, we shouldn't. We should hold it. So I'll buy here, and maybe I'll put a stop loss under this low, right? Why would I put a stop loss under this low? Because I know if price breaks that last higher low, what's bound to happen? We're probably going to go lower, right? Because price is telling me, oh, well, we broke that last higher low. We're probably going through reverse. Okay. So, that's kind of why you put a stop loss there, because again, let me show you from a short perspective. Okay. Now look at this. Ready? So right here, we create a lower high. Or we create a high, lower low, lower low, lower high. So what do I expect? Well, we're in a downtrend. What does a downtrend typically look like? Well, a downtrend typically looks like this. And what keeps happening? We keep rejecting on that pullback. So if I think that, well, then I think we're going to go like this. So what I'm going to do is I'm going to take a short right here, and I'm going to be like, okay, my stop loss off that short is now going to be above this high. Why this high? Because I think that if price is truly bearish, we're not going to go above the high. Just like how I think when we're in downtrend, we're not going to go above this high, then go back down again. That just doesn't happen. We're going to go right here, and then we're going to reject. So I know if price does go above this high, we're probably going to go much higher. So right here. So that being said, I'm going to put a stop loss here. I'm going to put a buy order here because I am short. And again, if price comes up and hits this level, it's going to get me out for looks like a pretty big loss actually. 20 times, about a $500 loss. Okay, price just hit my stop. I'm getting out. I don't like how we broke structure back to the upside, so I'm going to get out there because it looks like we're bullish, and indeed we are. So see how the stop loss would have saved me there? And again, that's why people place their stop loss there. So that is the third and final way I've taught you guys to get in the position. Again, we'll do another example right here. I see, okay, we have a high. It looks like we're in an uptrend. Uptrend. Okay, we broke the high again. We're still in an uptrend. I'm going to buy the retracement because I just think we're going to keep going up. So I wait for the retracement. Might buy here. And we just keep going up. And again, this is not using indicators. This is not using anything. This is only using market structure. Okay, higher highs and higher lows. And then where would your stop loss go here? Your stop loss would go below that last higher low, because if the market comes back down and breaks this, then what's it going to do? If it breaks structure, it's probably going to reverse and go like this, right? Because in order for an uptrend to maintain itself, it has to keep holding the last lower low or the last higher lows. Okay, and if those break, we're probably going to go back down. So, yeah, that's the 3 entries I've taught you guys so far. And I just wanted to recap that because, again, I've taught the concepts, but I haven't really taught you how to enter. And those are kind of the 3 different ways to enter. So, with that being said, I'm going to introduce something new. And I'm going to introduce something called market patterns. All right, there's a lot of different patterns. You can find a lot of these cheat sheets. A lot of them. Here's an example. You got bearish double top, bearish head and shoulders, bearish rising wedge, bearish expanding triangle, bearish triple top. And what's funny about this is all liquidity, but it's kind of just a pattern based off liquidity. Now, you're not going to understand what that means until probably a year down the road, but whenever you see these patterns, typically what's going to happen is these green arrows is going to be what happens. So, for example, let's look at a bearish double top. So, a bearish double top. Why might a bearish double top be good? Because if we make 2 peaks, that means price is likely to reject that again. So what people do is they see 2 rejections of the same spot, and people are like, oh, we rejected it, I'm going to short, or I'm going to bounce. And same thing for the double bottom, right? Again, double bottom is just the opposite, where we come down and we create a bottom where we bounce off of it twice. So that's just a simple market pattern. Okay, now how can you use this for like an entry, or how can you actually use this? Well, let me show you. Right, let's look at this for example. Let's say I'm not sure whether we're going to reject this or not. Right, let's say I kind of see a lot of resistance here. I'm not sure whether we're going to reject it. And then I see these 2 candles and I'm like, okay, I'm short. We rejected it for the 4th time. This is a double top. A lot of highs rejected it. We'll say this is the first top, this is the second top. I mean, there's technically, this is like a quadruple top, but you get the point. So after the rejection, I'm going to short because I think, oh, well, we rejected it a million times. We should keep going down. Well, where did I put my stop loss? I'm going to put my stop loss above those highs because I know if these highs break, it's going to be a resistance that turns into support, and a lot of times this will happen. So that's where my stop loss is going to be, and I'm going to take the short and see what happens. And boom. Now I'm at $500. We got a double top, and that's that. All right. So that's what a double top is. Again, a double bottom, same thing. Like right here. Let's say we come down here. Let's say I'd be like, okay, I don't know if we're going to bounce off this or not. But let's say I see this big giant green candle off of this low. I'm thinking, oh, well, because of this reaction, this will now be a double bottom. Double bottom. What happens after a typical double bottom? Price tends to go way up. Okay, so if I think price is going to go up here, I'm going to buy, and I'm going to sell at a much higher price, maybe right here. Okay, so that's just a pattern. You don't know the double top's going, or you don't know the double bottom's going to be the double bottom until we get that bounce or reaction. So I consider this the kind of candle you don't enter, and I consider this the candle that's like, okay, I can enter this now because now we see a double bottom. All right. So remember, you're not actually trying to enter and guess where the double bottom is going to be. You want to wait for the reaction of the double bottom. So that's kind of the first pattern I'm going to go over. And I'm not going to go over all these patterns. You're going to need to just look up a cheat sheet. You're going to learn so many patterns. And again, I do not use these patterns. These are patterns you want to use as a beginner, but you're going to laugh at these patterns in a year once you understand liquidity and once you understand ICT and what I'm going to teach you. So let's look at another one. Another one would be bearish head and shoulders. So I just type in bearish, or I'll just type in head and shoulders. All right. It's kind of funny. Again, so this would be head and shoulders, where we get a shoulder, and then we get another peak, and then we get another lower peak. So, example of head and shoulder would be right here. And we don't really get a good other right shoulder, but see how it kind of looks like a head here, shoulder here, shoulder here. So how do you trade it? Well, to me, what I do here is I'd be like, okay, kind of got this, I'm playing price. Okay, to me, this looks like a head because it broke a shoulder. I'm going to wait for a retracement and maybe put a limit order up here and take a short. But the sad thing about this is we actually never get the entry. So honestly, I probably wouldn't have taken this because it doesn't really come back enough for me to actually get filled to take the entry. But you get the idea. It's just a reversal pattern. Now, not only you can use head and shoulders, you can also use the opposite. So what if I flip this picture around? It's called an inverted head and shoulders, and it's just another reversal pattern. So if we invert it, it just looks something like this. Downtrend, downtrend, first shoulder, head here, second shoulder. All right. So an example would be something like this. So we create a low. This would maybe be our shoulder. We create a new big low. This would maybe be your head. And now we're expecting another shoulder, and I'm going to buy that next shoulder. So I'm going to buy like right there, expecting this or somewhere around here to be the next shoulder. Right? And where did I put my stop loss? I'd put my stop loss below this low because, again, for head and shoulders, do we ever go back onto the head? No. And if we do, you're probably wrong because this pattern won't play out. So if I bought here, just guessing that this is going to be the next shoulder, remember. And if we go here, I'm probably going to be wrong because this is not head and shoulders. This is shoulder, shoulder, another shoulder. So we probably go down more. So I buy there thinking that's going to be head and shoulders. And indeed, I just play price. And then again, right here, maybe I'll sell for $1,200 profit. Okay, so that's just another pattern. Again, it's not going to always look this clean, right? I mean, this example alone just isn't super clean. It's shoulder, head. Then we just kind of get a bunch of smaller shoulders, but any of these shoulders you can kind of buy, but they all kind of clump into big, like a one shoulder, like kind of pattern here. So you're just going to need to study this on the chart. Same thing. Like this is a super clean one. Look at how clean this is. Shoulder, left shoulder, head, right shoulder. And I'm going to tell you guys right now, these patterns mean nothing without narrative. These patterns will fail you if you have no idea where the market's going to go. But they're patterns you're going to see work a lot if you know where the market's going to go. And that's where I'm going to come in, and I'm going to teach you how to know where the market's going to go. All right. So I'm going to go over a few more patterns. We got bearish double bottom. Already did that. I mean, this is bullish inverted head and shoulders. Let's go over a wedge. So a wedge is, I'm going to explain what a wedge is and why it works so well. All right. I used to use wedges all the time. So a wedge, let me see if I can find a good example. I don't even look for these patterns anymore. It's very hard. This is going to be harder than I thought. You understand, like I don't trade these anymore. Okay, this would be a good example of a wedge. So a wedge is basically when we get a bunch of, so we obviously know market structure, a typical market structure should look like this, right? This is an uptrend. This is a downtrend, like that. So this is a downtrend. This is an uptrend. All right. What happens for a wedge is we actually get neither. How do you get neither? What happens, what makes a trend is higher highs and higher lows, or lower lows and lower highs. So what happens for a wedge is we get lower highs, but also higher lows. So let me just show you. So what happens is we get this. So see how we're creating higher highs, which this signals an uptrend. This signals an uptrend. But this signals a downtrend. So how do you know which one's going to work? You don't. You have to wait until the wedge kind of breaks and until we break this way or we break this way. And again, think about the principle of what makes a trend. What makes a trend is higher highs and higher lows. What makes a trend is lower highs and lower lows. And if you get both, lower highs, higher lows, that's not a trend at all. That's just chop and we're getting nothing. So in this example here, you can see we're kind of getting higher lows right here, kind of the same low right here. I'd consider this the same low. And then lower highs right here, right here, right here. And then look, see how we get this big momentum candle breaking below this wedge? That to me is a good short because, okay, we are creating higher lows and we're creating lower highs, but we end up breaking to the downside. And what's going to happen is all this liquidity built up in this wedge, it's going to be taken out on the breakout. And this is going to be something called a breakout trade. A breakout trade is when we break out in one direction and you go along with that direction. So because of this breaking to the downside, I would take a short. So I kind of be thinking, I'm like, okay, there's a wedge. I'm going to wait for a 5-minute close above or below this wedge. So if we get a 5-minute close above, I'm going to long. Or if we get a 5-minute close below, I'm going to short. So let's see what happens. Okay, there's your 5-minute close. I just missed it. I'm going to take a short there because, okay, the 5-minute just closed below the wedge. And boom, I'm out for $500 profit. So you can see a wedge can go both ways. There's bearish rising wedges. There's bearish expanding triangle. Like there's all kinds of things. And you're going to need to study the street, but you can probably find these in a lot of different examples. Again, see how every single wedge, like see how we break out one way, right? Like what I kind of just went over is more of a symmetrical triangle, right? So this is more of a symmetrical triangle where we don't know which ways it's going to break out and we just wait to see. And that's kind of why you see these arrows right here. Right, these arrows right here are going to be important because we don't know where we're going to go, but you can wait and take the play of where we're going to go after you see the breakout one way, and then you take the trade. So like there's bullish and bear flags and whatever. I'm being very honest. It's very hard for me to make this video. I used to use this stuff, and this stuff is very laughable now. I mean, this is bringing back a lot of memories. Let's go over a few more examples, even though this is very tiring for me to do because it's just so bad. Here's another one. Again, ascending triangle, descending triangle, pennant, bearish flag, bull. Let's go over bear and bull flag. So, a bear and bull flag. All a bear flag is going to look like is something like this. A bull flag. Right, see how this forms a little flag pattern? Right here. And typically, if we're already in an uptrend, remember, if we go back to market structure, if we're already in an uptrend and we see a bull flag, we should break out. Now, does that mean to buy? Does that mean, so a lot of people, this is where they get wrecked, and this is where so many retail traders lose. A lot of people assume everything's a bull flag, right? Would you not assume this is a bull flag right here? I mean, we break structure to the upside. Would you not assume this is a bull flag? I mean, I would, but it breaks to the downside. And the problem with a lot of people is when they're taking bull or bear flags, they assume this is a bull flag and they get in. They get in before it even breaks. They're like, oh, we're going to go up here. But confirmation, the word confirmation is going to be very important. We don't have any confirmation here. A confirmation would be, because we're in the 5-minute time frame, confirmation would be if we close above this wedge or if we close below this wedge. And whichever one we close above or below, that's going to be your confirmation of where the market's likely to head next. and that gives us short confirmation, not long confirmation, it closes below the wedge, and that's bearish. And what it was assumed to be a bear flag, or a bull flag, was assumed to be a bull flag, is a bear flag, and people get wrecked. So the biggest thing, and again, you will not be using bullish and bear flags. You just need to know what they are, okay? Just because you need to know what this stuff is if you want to get good in the market. Because you need to lose money using this stuff and understand the logic and why this is so bad. Like, the logic of why this is so bad is because people buy before the liquidity, right? Remember where people place their stop losses, above all highs and below low lows. So if we have a bunch of stop losses generated here and here, this candle running all these stop losses is going to continue and bring us way lower because there's so many people getting stopped out here. And it's just going to cause like a ripple effect, and the market's going to go down. All right. So, again, what I'll say about a bull flag is it's not always going to be bull flag. Make sure you wait for confirmation. All right. Again, I'll go to an example where it's like another bull flag, I guess. So like right here, we'll go to like the 3-minute. See how like right here, we kind of get a break in structure here, and we kind of form like this little, I mean, it's not really, this is more of like a trend line flag. Like, see how we get this consolidation between these two black lines? If I go back to the pattern sheet, let's see if this looks familiar to anywhere. So it looks like this. It's a bullish flag pattern right here. See this one right here? So this is a continuation pattern, and it's kind of where we form a flag here. See it? It's just a little flag. Now the confirmation would be when we break out, and then you might take a buy. So if I were playing a bull flag, what a lot of traders are going to do is they're like, oh, this is going to break out. I already know it. It's a bull flag. And sometimes they'll be right. Sometimes they'll be wrong. But what ideally you want to do is you want to wait for the breakout and then buy after that, just to be sure. But yeah, you can kind of see this is bull flag. And again, I'm not going to go over these patterns. I'm going to be straight up honest with you. If you really need me to go over all these patterns right here and you don't understand them, you're not going to make it in trading. You just should stop watching my course right now. These are literally just patterns, and you can match this up with what you see in the chart. I mean, I literally just matched this bullish flag pattern to this on the chart. It looks the exact same. And again, a bull flag tells us where price is most likely to go. But that's not the case, because you're going to get wrecked doing that. I'm just going over this before, because this is a prerequisite and what you need to understand if you want to actually get good at the market. Just remember that. Again, I don't use this. This is crap. This is all crap. This is crap. This is crap. All this is crap. You just need to know what it is and why it works the way it does. The science behind it is this. Why, like, what do all these have in common? Every single pattern has in common, they all have some sort of consolidation first. And if I go to YouTube and this is my mentor right here. And if I go to ICT, this is what I'm getting at. This guy's concepts is what I'm getting at for you guys to learn. And I go to his playlist, and I go to his core content month 1. All right. Elements to a trade setup. Here is a nice diagram. You learn this day 1. It's right here. How does price deliver? There's retracement, reversal, consolidation, and expansion. What comes after consolidation in price delivery? See the circle, consolidation? What comes after it? Expansion. Price expands one direction. And this is why patterns work the way they do. This is why these green arrows just really shoot up or down here. Because we get all this consolidation, and then price expands one way in a very aggressive manner. Same thing here. See how you get all this consolidation, right? And what comes after consolidation? Expansion. And we get that consolidation. Look what happens. Whoop, expansion. And it's because there's so much liquidity and so many orders being built up in this consolidation that when we rip out of it, we're stopping out a lot of people, because a lot of people are going to have their stop losses above old highs and low lows. And we generate so many old highs up here. Like we generate high here, highs here, high here, high here. We generate stop losses above all these highs, and they're kind of all consecutive. So when we get that big giant candle to stop them all out, and they have to buy back their position to get out of the trade so they don't lose as much money, that's going to cause the market to keep going up because they're buying back their position because they know they're wrong. And this is why patterns work the way they do, and why these are actually crap, and you should understand ICT better. But it's just kind of the science behind why these patterns work and why we get consolidation and then we kind of rip one way or the other. So again, you can go over these patterns if you want. Again, you can type in Google market patterns and you can match them to your chart, but these are not going to help you, and they're good to know. I mean, there's something called a cup and handle. There's so many patterns you could look up. This is a cup and handle. In reality, this is just a bull flag. See, right from right here to right here. It's all the same concept. They just combine them into different things, and this is why so many people fail, because they see these patterns and they don't understand why they work. They just do sometimes. And remember, a pattern will not work without narrative. So what do I mean by that? Well, again, let me show you an example. A lot of people think this is head and shoulders. And it is. See it? See how we get the head, shoulder, shoulder? But wait, look at this. If I go back in replay mode and I short here, I'm like, oh, this is a shoulder. This is great. We're going to go back and hit the next low. This is awesome. Bam, straight up through my stop loss, I get wrecked. And that's why patterns are not going to work for you, because you don't understand that. You don't understand the narrative. You don't understand where stop losses are resting. In this example, this head and shoulders isn't valid because so many reasons I can't teach you yet. But basically, this is called buy side liquidity. And again, I'll teach you that in a few videos. But you're going to see that's a clear head and shoulders pattern that just fails to re-hit the low. It makes a new shoulder, and it almost goes lower. It just doesn't fully hit the low, and we just go back up. So, again, these patterns will fail you a lot just because of that reason. And as long as you understand the science behind, okay, when we consolidate, we expand after, that's good enough. So you just need to make sure you're understanding that and the science and why these work. So I think that's going to be it for this video. Again, you can look up all these chart patterns if you want. They're just good to be, I guess, aware of. And yeah, that's it for now. I'll see you guys later, and peace.